the system that built modern finance before Wall Street existed. Modern finance didn't start in New York. It didn't start in London. It didn't start with the Medici banks of Florence. It started in a city that most financial textbooks never mention. And the instruments it invented, you used one this week. The real question. Here's the thing about finance that most people miss. It's not about money. It's about solving a problem. A very specific, very ancient problem. How do you move value across distance without losing everything? Because the moment trade expands beyond your village, beyond your city, beyond your border, you run into the same wall. Distance is dangerous, and gold is heavy. Welcome to the long game of wealth, where history reveals how money, power, and time create real wealth. The merchant's nightmare. Picture this. It's the 9th century. You're a merchant in Cordoba, Islamic Spain. You want to trade with a partner in Basra, in modern-day Iraq. That's roughly 5,000 kilometers. Through mountain passes, desert roads, bandits, corrupt border officials, and open sea. You're carrying gold coins, one ambush, one shipwreck, and everything you own is gone. No insurance, no recourse, no way to prove you ever had it. This wasn't an edge case. This was the defining problem of medieval commerce. And the city that solved it was Baghdad. Enter Baghdad. In 762 AD, the Abbasid Caliph al-Mansur founded a new capital on the banks of the Tigris River. He called it Madinat al-Salam, the city of peace. The world would come to know it simply as Baghdad. Within a century, it had become one of the largest cities on earth, home to over 1 million people at its peak. But size wasn't the point. Location was. Baghdad sat at the intersection of every major trade route in the known world, east to China and Central Asia, south to India and the Persian Gulf, west to Egypt and the Mediterranean, north to Byzantium and the Black Sea. Entire civilizations were funneled through one city, and where trade concentrates, finance must evolve to keep up. The foundation, portable law. Here's what made the Abbasid financial system genuinely revolutionary. It wasn't one clever invention. It was a system. And that system rested on one idea almost no one talks about: portable law. Across the Islamic world, from Spain to Persia, there was a shared legal framework. A contract, written by a merchant in Baghdad, carried enforceable weight in Cairo, in Damascus, in Samarkand. This sounds simple. It was anything but. For the first time in history, a trader could enter a binding agreement with a complete stranger, across thousands of kilometers, and trust that the law would back it up. When law becomes portable, commerce becomes scalable. The financial innovations that followed weren't accidents. They were responses to scale. Innovation 1. The Mudaraba. The first breakthrough was called Mudaraba, and it solved a problem that still exists today: the problem of capital and expertise being stuck in different hands. A wealthy merchant in Baghdad had gold, but no time, no desire, and no knowledge to trade across the Silk Road himself. A skilled traveler had expertise, contacts, and a network, but no capital. Under Mudaraba, they entered a partnership. The investor, the Rab al-Mal, provided the funds. The agent, the Mudarib, provided the labor and expertise. At the end of the venture, profits were split according to a pre-agreed ratio. And here's the crucial part. If the venture failed, if the ship sank, if the goods were lost, the investor absorbed the financial loss. The agent lost only their time. No one was indebted. No one owed interest on a failure. Risk was shared. This structure was so sophisticated that when Italian merchants encountered it through trade with the Islamic world in the 11th and 12th centuries, they adopted it almost wholesale. They called it the Commenda. It became the legal foundation for the European Limited Liability Company. The corporate structure that underpins global capitalism today has Arabic roots. Innovation 2. The SOC. But Mudaraba still didn't solve the original problem. The gold still had to move. So the second innovation was even more audacious. What if the gold didn't move? What if, instead of carrying wealth, you carried a promise? This was the sak, from the Arabic verb meaning to write. A sak was a written order of payment. A merchant in Baghdad would deposit gold with a trusted financier, a sarif, and receive a document in return. That document could be presented at a partner institution in another city. The cash would be paid out there. The gold never moved. Only paper moved, only information moved. This was the world's first widely used check system. And here's a detail that should stop you. The English word check is derived directly from the Arabic word sak. You write a check today because a sarif in 10th century Baghdad needed to move money across a desert without getting robbed. The system scales. Now something remarkable happens. With Mudaraba, capital finds expertise without requiring debt. With the sak and hawala, the trust-based transfer network, money moves without physically traveling. Risk drops, transaction costs fall, trade accelerates. By the time of Abbasid Caliph al-Muqtadir in the early 10th century, the financial clerks of Baghdad, the sarifs, had begun performing most of the basic functions of modern banks. They had their own markets, something akin to Wall Street, and fulfilled all the banking needs of commerce, agriculture, and industry. Baghdad wasn't rich because it had resources. It was rich because it had better rules. The transfer to Europe. Finance doesn't respect borders. It flows toward opportunity. As trade between the Islamic world and Europe grew, through the Crusades, through the merchant cities of Venice and Genoa, through the spice routes, ideas traveled with the goods. The Islamic contract Mudaraba was used by Italian merchants who called it commenda, a forerunner to today's limited company. Post-Roman Europe was demonetized and used the trade of furs and lumber with the Islamic Caliphate to get desperately needed hard currency. The bill of exchange, the letter of credit, the concept of institutional money transfer, all have documented predecessors in the financial practices of the medieval Islamic world. European finance didn't spring fully formed from the Renaissance. It was assembled piece by piece from a much older tradition, a tradition written in Arabic. The divergence. But here's where the paths split. As European finance developed through the Renaissance and into the early modern period, it made a fundamental shift. It moved away from risk sharing and toward debt. Interest-bearing loans became central. Leverage became the engine of growth. And this worked spectacularly for a time. Debt allows economies to grow faster than their underlying assets. You can build before you earn, expand before you profit, consume before you produce. But debt creates a structural fragility that risk-sharing doesn't. When a Mudaraba venture fails, the loss is absorbed and the relationship ends. When a debt-based system fails, everyone who borrowed is still obligated. Everyone who lent wants their money back. And the whole structure can unwind simultaneously. The modern connection. In 2008, the global financial system nearly collapsed. Not because of bad luck, because of the fundamental architecture of the system. Trillions of dollars of debt, packaged and repackaged, leveraged on top of leveraged. When the underlying assets fell in value, the entire pyramid shook. Islamic finance requires that financial transactions be tied to real, tangible assets, which helps deter speculative practices that can lead to economic crises, such as the 2008 global financial collapse. This isn't an argument that one system is perfect. Every system has its weaknesses. But it is an argument that the system we inherited is not the only one that was ever built. 1,000 years ago, a different architecture existed. One where risk was shared, not offloaded. Where transactions were tied to real assets. Where the collapse of one venture didn't cascade through an entire civilization. The lesson of Baghdad isn't just about Islam. It isn't about which civilization was better. It's about something more fundamental. Financial systems are designed objects. Someone built the rules. Someone chose what to incentivize. Someone decided who absorbs the risk when things go wrong. Those choices shaped who got wealthy, who got left behind, and how catastrophically things unravel when the system breaks. The Seraphs of Baghdad understood something that modern finance sometimes forgets. A system that shares risk is a system that shares survival. And perhaps the most radical idea you can take from this video is that the financial world we live in today wasn't inevitable, it was chosen, and it can be chosen differently.